One of the reasons people have been blaming mortgage brokers and lenders for the collapse of the real estate industry, it really is much more broad than that. One of the things we need to really look at is who are the culprits? And unfortunately, most of us aren't going to like all those answers. We're going to start at the top. I think you've got to look at the federal and state governments. Some of the things that they've done has been just walked right into this problem. We'll get into that in a second. The second one is the Federal Reserve. Alan Greenspan's out there telling get an adjustable rate mortgage right before he raises the rate to the longest increase in our history. Then you have the investment bankers at another top of the chain. They're sitting there begging the mortgage lenders, I need more product, I need more product. And of course, people can't qualify for more product. So they come up with products that they can qualify for and gets a bigger pool of people. Then you have the mortgage lenders. I mean, they're wanting to make the money on this, and these subprime loans were very attractive at making money, especially those pay option arms. And then they increased the risk by adding different layers of it, which we'll explain in just a second. And then you have the mortgage brokers. They're out there just trying to make loans. And too often when people don't qualify, they've been known, a few of them have been known to do things that were not exactly kosher. And finally, and I hate to say this, consumers. People got into loans they didn't need to get into. And too often they were told, not only by the broker and the lender, by disclosures and upfront, at closing. I've never been to a closing that the lender, at the closing attorney or the title company, depending on who you went with, actually didn't go through the details on those closings and what your loan really was. Is adjustable rate mortgage and you have 4 payment options, or it's adjustable rate mortgage and here's your index and here's your margins. And when they do that, it may be foreign to you, but you're buying a $200,000 to $500,000 or $1,000 house or more, and you don't even know what you're getting. I mean, there's some culpability there too, unfortunately. The first one I want to talk about is the federal government, and they don't want to even talk about their culpability in it. But they've done something in the 70s called the Community Reinvestment Act. On its face, it sounds great. Hey, banks, you're supposed to be investing in your community. But in fact, what this act has done is, hey, you've got to invest in this community whether or not these people qualify. And if minorities are involved in it, they've got to really get to those loans too. And so what happened was the banks were too often doing loans that they felt forced and obligated to do to people who didn't qualify. It wasn't necessarily the community, it was the individuals who didn't qualify. And when that occurs, they had to sit there and scratch their heads and say, well, how can I make money at this? I can't just keep making loans to people who don't qualify for the mortgage. So there comes the beginning of the subprime industry. Obviously, if the rates are higher and the fees are higher and they can make a little more risk capital for making those more risky loans, then they can turn around and offer these loans to individuals because they'll have a higher risk basis and risk tolerance, and they get a better return and also have more money reserved for the losses that they may incur. So the Federal Reserve starts by, or the federal government starts by forcing the banks to make loans in these areas. State governments also have been culpable for it, especially recently. When the crisis started, then they said, well, gee whiz, now you can't do any more stated loans. 2 or 3 states have gone out there and actually created laws that says you can't have a stated loan. Well, stated loans aren't necessarily the problem. It's who they're sold to. When you're doing a stated loan to a maid who gets a salary and stating that her income is $120,000 a year, quite frankly, that's just fraud. But that's what it ended up going to, which is brings in some of the other parties. But when you say there's no stated loans, the people who are self-employed, who may not show as much income because they take off much of it in the business transactions, and they can easily afford a bigger house, now they can't qualify for it because you don't have the stated loan products. And what that does is shrink down the pool of possible buyers for your home, and then turn around and make your house value, in essence, lower. Less buyers, less price for the house. More buyers, more price for the house. And so by doing some of the things in the state governments, by limiting the products, they've turned around and hurt the actual market worse. And let's look at the Federal Reserve. The Federal Reserve's out there, and they're saying, Alan Greenspan back in 2006 gets in front of the Committee on Housing and says, historically, which was true, adjustable rate mortgages were the best rates to get. But then within a couple months, they start the longest increase of rate increase in their history in terms of quarter here, quarter there, quarter there. Every time they met, they were going up a quarter until the rate significantly increased. So when the adjustable rates converted and their rates adjusted, all of a sudden their interest rates went from 5 and 6. Now your interest rates are 10 and 12. Now the people don't qualify for it. So the Federal Reserve sits there and tells people to get into adjustable rate mortgages when in fact that was the worst time to do it. The next one is the mortgage investment bankers. Investment bankers have really paid a price. Unfortunately, everybody in this industry has paid the price. The consumers, the lenders, the brokers, the investment bankers. Everybody thinks that nobody's paid the price but the consumers, but that's not true. The investment bankers, like Bear Stearns, who most of their top staff are gone now, were the biggest culprits in getting product. They were out there telling lenders, I need more product. Lenders say, the people don't qualify for more product. Well, let's look at different ways to do that. And people like Wells Fargo and Countrywide Mortgage, they came up with a new product that is called the Pay Option Arm, which means that you have 4 payment options. On these options, you can do the minimum payment, which is generally 1%. But what happened was, and what oftentimes the borrowers didn't know, is that the value, it was actually a 7% loan. The difference between 1% and 7% or 6% annually went back on to the principal of your mortgage. So that you had a $200,000 home, the next year it was now cost you $212,000. And everybody didn't mind that in California because they felt, oh, the rates of the housing market will go up more than the 6%. But that's not true. Always when there's an up, there's a down. So eventually the market couldn't protect itself against this downward trend. And these investment bankers and lenders created these products that couldn't qualify. In addition to that, that product is not necessarily bad in itself. It's great for seasonally paid people. Like if you owned a restaurant and you had seasonal customers at the beach in the summer, but in the winter it was slower, those are great customers. You pay less on your payment in the summer or on the winter, and higher in the summer when things are going real well. So you can really do well on that type of mortgage. That was what the design for, but it got abused. Now nobody could afford a mortgage in California. A normal home would cost $6,000 a month, and the people couldn't qualify for more than $1,500 or $1,800. So what do? They let them qualify for $1,500 a month by paying the minimum payment always, and that was a tragedy. In addition to that, they added different layers of risk. What does that mean? Well, they made it a stated loan. In addition to having a low interest rate, they made it a stated loan. Well, that means people could state their income. And in California, approximately 80% of all loans that are stated loans are fraudulent. They were taking people and just putting the amount of their income on what they needed to qualify for as stated. And that's not what it was designed for either. So not only did you have the pay option arm, then you had the stated level of risk. And finally, they said, hey, these people don't have good credit either. So they made the subprime level of risk. And when you add all 3 of these risks, it's no wonder the mortgage and the real estate industry collapsed because people couldn't afford what they were getting. And finally, you have the mortgage brokers. They were culpable because they didn't bother to know what the people made. They just put their income down and did the stated loans too often. Or often gave them a product that they could make the most money on instead of getting the product that was the best for the consumer. And finally, you have the consumer. Look, guys, each of us if we're going to live in a free society, we've got to be responsible for our own decisions. As I was always told as an individual, freedom equals privilege, and it equals responsibility. So if you're going to have to get a loan, you better know what you're getting. And each of us probably knew what we got. And unfortunately, oops, we made that bad decision. And now, who's going to help me get out of my problem, which I chose? If you're in that predicament, there are solutions, and we'll look at that next.